How can you use credit cards to build a better credit score? And should you even bother? Ted's here. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
This is episode number 530 of this podcast.
Okay.
Unless we renumber it before we publish it. And today, for the first time ever, I'm going to introduce ourselves. I'm Doug Hoyes. That's Ted Michalos.
Hi.
Because people have been going, okay, well, wait a minute. Which is Doug and which is Ted? And that's why when people phone us, they say, can I speak to Ted Hoyes, please? No, we're two different people. So here's my question for you. Have you ever had a client say to you, someday I want to buy a house or a car, get a car loan, decent rate, so I need to improve my credit score? Is that ever an issue that comes up?
Just about everybody.
And is this something you believe we should obsess over?
Well, I have a pretty low opinion of credit scores and the credit reporting system, so I'm going to say no.
And
I think we're on the same page.
I agree
with that
with
one,
you.
right?
I agree with you. And this is kind of, the problem is there is some stuff where you need a good credit score.
Well, the problem is that there's so many different credit scores out there, you don't really know what the hell you're looking at.
So explain that then. So there's obviously Equifax and TransUnion. That's two.
Well, so let's start with some history. In the U.S., they have FICO scores and Beacon scores because in the U.S., they literally have thousands of banks. And so they're trying to establish a system whereby people could get some sort of reference for your credit worthiness. What's your payment history been like? How much credit have you accessed? Because you could be dealing with 3 or 4 different banks. Here in Canada, we don't really have that same issue. We've got the major banks that everybody's dealing with one or the other of those. And the credit score isn't really used the same way, or at least it wasn't originally. It's pushed its way into our culture because there's so much U.S. media that we hear about that now people are asking about credit scores in Canada, but I don't think they really mean anything here.
Well, my counter argument to that would be banks don't do anything anymore. There's no employees there anymore. Everything's done by a computer.
Right.
So you go online and apply for a loan, and the computer goes, yes, you get it, no, you don't. And the way it's doing that is by looking at your credit score. But I agree with you that there is not just one credit score,
right? Because
every bank, every lender interprets it differently.
Well, and on top of that, you've got these 2 or 3 credit services that allow you access to credit scores that are using their own damn algorithms.
Yeah, so you've got, and you're talking about like all the free guys, Credit Karma and Mogo and Borrowell and those kind of things. So what they are doing is pulling data from either TransUnion or Equifax and then doing whatever it is they do with it. And that kind of makes sense because if I'm a lender, well, let's take a simple example of a mortgage lender.
Right.
You come to me, you want a mortgage. Well, what do I evaluate you based on? I could say, what's your income? I could say, what are your other assets? Or I could say, what's the value of the property?
Sure.
There are some private lenders who don't care what your income is at all. We'll lend you up to 50% of the value of the property because if you don't pay, it doesn't matter. We can sell the property and get our money back.
Right.
Whereas there are other lenders who, well, we don't want to be taking the property. We want to know that you can pay the loan. So your income becomes a bigger factor. So whatever the debt, the type of borrowing you're doing, there's different criteria that they use.
Right.
So the point is, and just for everybody who's watching here, we'll put timestamps in the episode.
You almost got the point there, folks.
I almost got to it, but we're going to put timestamps in the episode. We usually do. So if you want to skip over whatever it is we're talking about and get to whatever it is you want to hear, it'll be there. Okay. I'll warn everyone, we've only got 2 cue cards today. So.
Which is 2 more than I usually get.
Usually.
I think this is an improvement.
And you only saw them 12 seconds before we started. The point is that every lender uses a different system, a different algorithm. So when you go into Equifax and it says your credit score is 623, that is not necessarily the score that your lender is looking at.
Right. Certainly isn't the score on TransUnion. Certainly
it may be different on TransUnion or anywhere else. And even if that is your score, well, what does that mean?
Right. Is that good? Is that bad?
Yeah. So is it the limit is 640? You got to be at 640 or we're not going to get it.
Right.
So that's why you and I both believe you should not be obsessing over credit scores because what you're looking at is not necessarily relevant anyways. So if you're not going to obsess over a credit score, what should you obsess over? What's important?
Well, how much debt are you actually carrying? How much income have you got? How much money do you have available to make the payments for whatever loan it is you're going to be applying for?
Yeah. So if I gave you a choice, I said, here's your choice, Ted. You can either have a credit score of 880, which is pretty good, or a credit score of 700, but I'll put $1 million in your bank account.
Do I have to pay the $1 million back?
No, I'm just giving you the money. And maybe it's not me giving you the money. Maybe you're the one who saved it up.
Yep.
Well, okay, this is kind of a no-brainer. I would rather have cash in the bank than a perfect credit score.
Right.
Because I don't need credit if I can just go out and pay cash for it.
Well, and if you have a perfect credit score, as soon as you apply for and use credit, it's going to drop anyway, right?
Yeah, well, that's the other thing. It's not cast in marble.
Right.
I guess you don't cast in marble. I think you use something else. But
etched in marble.
Etched in marble. It's constantly changing. So if you have a car loan and you're making your payments every month, that makes your credit score look good. But once you pay off the car loan and it drops out of your history,
right,
well, that may make your credit rating go down, which doesn't make sense because didn't I just pay off my debt? So let's talk about, and I know some people understand this, some people it's a little confusing. So what goes into the algorithm to calculate your credit score? Because in order for us to figure out whether I should be using credit cards to build a better credit score, I kind of have to know how it's calculated.
So the credit reporting agencies have members that are credit grantors. So you and I aren't members of the credit reporting agencies, Equifax and TransUnion. The banks are, various Visas and MasterCards, various utilities. Anyone that grants credit commercially is probably a member of the credit bureau. Every month they report what's your approved limit, what's your current balance, did you make the required minimum payment last month, is it in good standing? So that's pretty basic stuff.
And they're reporting facts.
Right.
Like this is how much your authorized limit is, this is how much you're paid. And so those factors are all weighted, and there's really 6 of them that go into the score.
Yep.
So let me throw each one of these at you and you can give me your thoughts on it. So number 1 is your payment history, which is, are you paying your bills on time?
Right. And so your credit report's going to show a series of history. Are you a good payer? And that's important to anybody that's going to lend you money, because why would I lend you money if you're not a good payer?
And your history changes every month.
Right.
That's what history means. So if I have a period of time where I get a couple of months behind, but then I get caught up and I've been caught up for the last 6 months, my history is now improving.
Correct.
Compared to where it was 6 months ago. And sometimes they report it as a series of single digit numbers. You know, here's 24 digits. If it's all ones, that means you've always been up to date.
Or they'll print out the history of your payments.
And they'll do that as well. So you can see it. So you kind of hit on the obvious point. Well, if you want to do one thing to improve your credit history,
pay your bills on time.
Pay your bills on time.
And so if you want to manipulate your credit history, make sure you make your payments every month. So even if you don't need to use your credit cards or credit, if you buy something and pay it, that improves your credit usage.
Yeah. So, and you buy it and pay it right away.
Right.
That means your history of paying on time is very good. Now, the second element of history is the age of your accounts. Why would that matter?
Well, so how long have you been carrying this debt? Is it a brand new debt that the history is 2 months, or have you been paying this car loan for 5 years now? And so again, it reflects on how good a payer are you.
Yeah. So, and this is where we get into the whole credit card thing. If I've had a credit card for 10 years, that gives my score more weight than if I've had it for 6 months.
Right. Or if you've had 7 of them for 3 months.
Yeah.
Every time you get a new one, they go, oh, okay, he's got a new one. So what's going on here?
And clearly, yes, a new one does not help your history because it's a brand new thing. So number 4 on our list, I'm skipping over number 3, is stability. So stability of having the card, but also stability of other aspects of your life.
Right. So, I mean, think the credit report is a list of all these commercially listed debts, your credit cards, lines of credit, loans, whatever. Stability indicates that you're consistently paying all of them. So there isn't if one of them you missed 1 month, they're not going to get too excited about. But if every March, April, May, you don't make your payments because of some winter post thing, it makes a difference. So they're looking for consistency as much as stability.
And they're also looking for stability in your life.
Right.
So have you lived at the same address for a long period of time? Have you had the same job for a long period of time? Now, jobs are not necessarily reported on a regular basis. So that's much less of a factor than it used to be. Whereas your address, well, everybody knows what your address is. That's one of the ways they link your report to you, in addition to your name and birth date and everything else. So if you've been at the same address for 10 years, that indicates more stability than if you move every 6 months.
Right.
So, okay, try to be, kind of hard. If there's a better job over there, I'm going to move. So this is a classic example of where we think you should do what's right for you, not what's right on your credit report.
Right.
Your credit score will be better if you stay at the same house for 50 years. That's not
and you
how,
pay your bills.
And you pay your bills. That's not how it works in real life. Okay, let's go back to point number 3, which is a more important point, and that is utilization. So explain what that is and how that works.
So everybody needs to understand something really basic about credit. Credit is good. Debt is bad. So as soon as you use the credit, it turns into debt, which means you're utilizing your credit, and that's basically bad.
Credit is good, debt is bad.
That's our whole culture is built on that. So you get congratulated when you get approved for credit, but when you actually use it and turn it into debt, now you're paying interest.
So I always thought credit and debt were the same thing.
Credit is you haven't used or incurred the debt yet. It's permission to borrow money. So credit by itself isn't really a problem. It's when you actually borrow the money and you got to pay it back plus interest that it becomes a problem.
And I've always long believed that words matter. That's why we call them credit cards, not debt cards, because credit is a positive thing, debt is a negative thing. If we called them debt cards, well, I don't want to go to the store and use my debt card.
You might not use them anymore.
I might not, yeah. I'm racking up debt. So, okay, so back to utilization then. So give me a mathematical example.
Right. So let's make it simple. Let's say you've got 2 credit cards, each with $5,000 limit. So your maximum credit available is $10,000. And this month, you're carrying a balance of $1,000 on one of the cards. So 1,000 over 10 is 10%. That's your utilization.
And the lower, the better.
Right.
That's the trick. So, and we'll talk about how you can accomplish that. But yes, so utilization, very important. The lower, the better. So we've talked about the history of paying your bills on time, the history, the age of your accounts, utilization, stability, how long you've been at your same address. Number 5 is credit mix.
Okay. So do you have 29 credit cards, or do you have 3 credit cards, a line of credit, a car loan, and a mortgage? Like what's the credit that you have available look like, and how expensive is it going to be if you actually use it?
Yeah, and I have no idea how the algorithm is calculated because they won't tell me.
Right, and they'd all have to tell us differently anyway.
Right, so. And if they did tell us, then we'd be all actively gaming the system.
And they'd change it.
And then they'd change it. But it intuitively makes sense to me that if I'm a lender and I see that someone has a mortgage, a car loan, 2 credit cards, it's like, okay, that's kind of what a typical person would have.
Right.
But in your example, if someone has 27 credit cards, doesn't have a car loan, doesn't have a mortgage, that seems like a bad mix to me.
And the reason I used 27, the record was I had a client come in with 29 credit cards. Right.
So there you go, people.
Something to shoot for.
Go for 30. Go for 30. So credit mix is part of the algorithm. I don't think it's as big a part as history or utilization.
Right.
And then the final element of the algorithm is inquiries.
Right. So this one is every time someone looks at your credit report or you apply for credit, it's supposed to be listed as an inquiry on your report. And that shows how many times either somebody's looking at you or you're looking at getting new credit someplace else.
And when you get your credit report, you can actually see. If you're getting it directly from Equifax or TransUnion, there's an inquiry section and it shows everybody. So some of them will be exactly what you would expect.
Right.
You know, my line of credit lender, they check my credit every 3 months just to make sure. There's a difference, of course, between a soft hit and a hard hit.
Right.
A soft hit is where your existing lender is just keeping an eye on you. Mm-hmm. And I had a VP at one of the big banks tell me once that, yes, we do a soft hit on every one of our clients every 3 months. And that way we can see whether something has gone wickedly off the rails.
Right.
And whereas a hard hit, as you said, is when I go to apply for a loan, they do a hard hit on my credit report. Now, if I go and apply for a loan and I get a hard hit, that doesn't mean my credit score goes down.
No, but what they're watching for there is that you have 3 hard hits on the same day. And so I've gone out and I've applied for 3 new loans at 3 different places at the same time. What the hell's going on? Yeah,
and I don't think that would necessarily impact your credit because that's kind of what I would do. I'm going to shop around. But if I have a hard hit and then 2 weeks later, 2 weeks later, 2 weeks later, that probably means I got denied, went to another place, got denied, went to another place. Right. So I'm sure the algorithm is sophisticated enough to look at that. But the point is, the more debt you apply for, And particularly if you don't get it,
Yes.
that's going to negatively impact your credit score.
Anytime you're refused has a negative impact. And frankly, if you're refused more than twice in a very short period of time, it's going to have a very negative impact on you.
Right, because obviously somebody has looked at it and said you don't qualify.
But you know what else is different? So let's say you don't think you're going to get approved at the bank, so you go to some of these second-tier lenders, the people that have long hours and they're easy to get loans at. That's going to have a negative impact on your credit report as well.
Which I think also factors into credit mix.
It does.
So if all of your debts are with these B lenders, if you want to call it that, and you can tell because their interest rate is 30% or 40% or whatever, or higher, then, or payday loans, which is,
you had to work that
I had to get that in there today. So that's clearly gonna have a negative impact. Okay, right. So let's go to the question of the show, which is, how can I use credit cards to build a better credit score? So there are these 6 factors, and again, we're not sure exactly what the rating is, or the ranking, the weighting is of them.
Right.
But they're all kind of obvious. So paying bills on time, that seems obvious.
Right.
Pay your bills on time.
Make the minimum payment that they're asking you to make. There's no real advantage to paying extra, except for you're getting clear of the debt free.
While you're saving on interest.
So if your intention, though, is to build a better credit use history, then you want to do what they ask you to do every month.
Yeah, or more. So I am a believer in paying my credit card every time I get paid.
Right. I do the same thing.
And now in our case, we both use our credit cards for business because
so we don't have any choice.
We do not carry credit cards with $1 billion limit. So it's very common for me to be paying my credit card every week.
Right.
Because we're putting, business expenses on it and so on. So I'm a big believer in that, though. So you're right. At the absolute minimum, you have to make your minimum payment every month.
Right. And we already alluded to this earlier, too. There are times, particularly if you're trying to build a new credit history, where it makes sense to actually use the credit card and then pay it off so that you're showing them that you're using it as a tool or a convenience rather than a necessity.
Right. I don't need your money.
Right. But I'm going to
use it anyways. And so, okay, I go put gas in my car. I'm not saying you should go home immediately and pay your credit card.
Right.
Because it might not even be posted yet. But if you get paid every 2 weeks, you can go online, see what your credit card balance is, just pay it. And that way you're never getting into trouble.
Right.
And you are obviously paying your bills on time or earlier.
And you won't get hit with interest. So.
And and you won't get hit with interest. That's kind of the most important point. And credit card, the billing date is completely randomly made up.
Right. Well, and every once in a while, the banks will change your billing date. I remember maybe 3 years ago when TD did this, I was always getting billed on something like the 28th, and then they backed it up to the 15th. So the first month they got me.
Yep.
And I was mad as hell.
Yeah. Yeah. And why was it the 28th or the 15th? No reason. Right. That's just the day. Maybe that's the day you applied for the card. I mean, who knows?
It's got something to do with their system.
Something to do with their system. But if I'm paying it in full every payday and I get paid every week or twice a month or whatever, then I can never be late.
Right.
That's the key. So I'm a big believer in pay your credit card bill as often as you get paid. In terms of history, this is an interesting one.
Mm-hmm.
So back to your conspiracy theories here, which you didn't raise, but I'm going to pretend you did.
You're going to saddle me with that one.
So using your example of a bank with the initials TD,
right,
who are not a sponsor of this show, but if they want to be.
But they could be.
Hey,
We're using their colors.
That's I guess, kind of true. I think they're using my colors, but okay.
Right.
530 episodes, still no sponsors. So let's say I've got the green card from them, which is their
Emerald.
Basic. Oh, Emerald. Is
That's
that
what they call it, yes.
Emerald.
Mm-hmm.
So it's their basic card. That's your entry-level product.
Right.
And then they call, and I've had this for 10 years.
Mm-hmm.
And then they call me up and say, oh, Mr. Hoyes, you're a great guy. We love you. We would like you to get our gold card.
Mm-hmm.
I don't know if they have a gold card, but let's assume that they do.
Right.
So I go, oh, that sounds good because I will be a better human being if I had a gold card that will...
Credit is good.
Credit is good. That will inflate my sense of self-worth. So I say, fantastic. So they say, okay, no problem. We're going to send you the new gold card, which of course has a bigger limit, and you get free stuff or something. I don't know how it works. You probably have paying a bigger monthly fee too, but we won't get into that. Right. So we're going to send you the new gold card, and then a month later, we're going to cancel your green card. Okay,
are they going to cancel my green card?
Well,
that's a good question.
This is the question. If they do cancel my green card,
Right.
I've just pooched my history.
Right. Your 10 years of history. Now, it'll still show when somebody does a credit report for you, but it'll show the balance is paid off, and that debt will be rated as 0.
Right. So it's not getting weighted very heavily if it doesn't exist anymore.
Right.
So upgrading to the gold card or the platinum or the molybdenum or whatever it is, that makes me feel good, but it might also toast my history.
Right.
So you got to decide, is it worth it? And the same thing would be true of, well, I'm going to switch to the American Express card now, or the MBNA card. And I cancel one and switch to the other. I'm all in favor of canceling cards,
Right.
but that's going to pooch your history. So you got to keep that in mind. Utilization. We already talked about this. Again, my system of paying my card every payday keeps my utilization low.
Well, the funny thing about this one, though, is particularly at the Christmas season, would you like to apply for our credit card? And you sign for it, you get 10% off that day. And now your total available credit has gone up. Your utilization's probably gone down, but things aren't going to look as good. So if you have a ridiculously high limit, that impacts the utilization numbers too.
Yeah, and I think there must be a level where it's a curve where it keeps getting better until it doesn't.
Right.
So if I've got 2 credit cards and I apply for a third one, my total available credit goes up, my utilization therefore goes down. That makes me look good. If I apply for 50 cards, is that going to have an impact?
I would hope.
I'm thinking it probably does.
Right.
So you got to be a little bit careful of that. Stability. Here's the other interesting one. So I said that if you're at an address for a long period of time, that indicates stability.
Right.
So how do you game the system? Well, here's my theory on it. So
everybody gets your address. Is that
that's it? That's exactly it. Well, so let's say you are 18 years old, and you're not much older than 18, I don't think.
Not much.
And you're
reverse the numbers.
There you're going. You're going. Yeah, I guess you are closer to 81 than 18. So you're going off to college.
Right.
Okay. You're boy with a dream. So what do? Do you put your address as your new address at college, or do you say, no, leave it at my parents' house?
Right. So if you put it at your new address at college and you're a typical kid, you're going to move either once a year or once a semester. And so stability is just out the window.
And then when you graduate from college, and we hope you do, then you're probably not living at college anymore.
Right.
So there's another move. So one of the strategies, I don't know if this is legal or not, but we're just here to give,
financial advice,
fake advice. But if you know you're going to be moving, maybe you're working as an intern, then you're going to switch. Okay, well, I'm going to leave my address at my parents' house because that's kind of where everything can go anyways.
Right.
And that way
they're paying the bill anyway.
They're paying the bill anyways. And so it's only when I'm now, firmly established somewhere else that's when I switch it. Credit mix we already talked about. And so I think keeping the number of payday loans to a minimum is probably a good idea.
Right.
And the B lenders and all the rest of it, and inquiries. So again, if you're going shopping for a car and you're going to 3 different car dealerships, okay, it's kind of understandable that you would apply at 3 different places. I'm going to go with the best deal. But don't continually be applying for stuff over long periods of time, because that's going to hurt you.
And don't be afraid of looking at your credit report yourself, because when you look, it doesn't count as a soft or a hard. It's you. You're the only one who actually sees that you have looked at your credit report.
Yeah, and I'm a big believer in getting your credit report directly from Equifax or TransUnion.
I agree.
You can get both of them for free.
Yep.
You don't get your credit score for free. But we've just said that you shouldn't be obsessing over that, because what's more important is all the other stuff we talked about.
Right.
So you can set up an account with Equifax and TransUnion for free and have access to your credit report. Many banks also have it as part of their app. So check your banking app, see if it's there. What you're looking for is anything that looks wacky.
Right, because they make mistakes on these damn things all the time.
Well,
it's whatever data is fed into the system, that's what they produce on the reports.
Yeah, I don't know if I've ever seen one that was 100% correct.
Right.
It's highly unusual, because you're right. They're taking all this data from all sorts of places. Some of it's got
depends on how unique your name is.
There you go. Yeah. So I've got a relatively unique name, so I'm in pretty good shape. But I think that's really the key. Take a look at your full credit report, and maybe you take a look at it every 3 months. Maybe you look at Equifax, then look at TransUnion 3 months later.
At the very least, look at it once a year. I mean, more frequently, don't look at it every bloody day.
No, it's not like stepping on the scale every morning. Right. It's important if you are applying for a big hunk of credit. I'm buying a house. I'm getting a car loan.
Right.
I am moving to a new apartment. I know they're going to check my credits. Okay, in advance of that, check it. And if there's errors on it, get them corrected.
Mm-hmm.
But focusing on the minutia just doesn't make any sense.
And if you think your credit is a bit dodgy, and you're likely going to want to apply for a mortgage or a car loan, go in and talk to the bank and ask them what they would like to see for you to improve it. Get them on your side. They're part of Team Ted now. They're going to tell you what you need to do. When you come back in 6 months, you've done those things, it's harder for them to say no.
Yeah, and if you're an existing client of the bank, it's probably easier to go to the bank and say, okay, I'm thinking of getting a car loan.
Right.
What can you do for me?
Mm-hmm.
Well, because they're already your bank, they can call up all your information on their screen and they can see, oh, there's an issue here, there's an issue there.
Right.
Now, lenders are not supposed to give you a copy of your credit report.
Yeah, it's a very strange.
It's against the rules, because
Yep.
we want the customer to pay for it. We don't want to give them anything for free. But if you have a relationship with the lender, it's not uncommon for them to spin their screen around and say, well, you can see this here. It's showing a late payment on this. And you're going, I don't have an account with that cell phone company. I don't even know what that's about. You get that corrected and then you're in good shape. Right. So, okay. So the question of the show was, using credit cards to build a credit score, should I? So what is your concluding comment on that? What are your thoughts?
Well, so if you're using your existing cards in a manner that shows that you're using them as a convenience, not a necessity, I believe it'll have a positive effect on your score. I'm not in favor of going out and getting new cards or deliberately racking up hard balances and carrying them. That's not going to do what you want to do.
Yeah, I agree. I think the key thing is do what is right for you.
Right. Because you're the only one who really cares what's going on with your finances.
Nobody else cares. Everybody else wants to make money off you.
Right.
The lenders want to earn their interest. The retailers want to sell you stuff. Everybody wants to make money over on you. So what works for you? So I think, okay, having two credit cards kind of makes sense.
Yeah, we've always been advocates of if you've got more than two cards, you've got to start justifying each additional card after that.
Yeah, and there may be a reason for it. You may have a card with a $500 balance that you give to your kid who's going to school. You've got your main card, and then you got another card that is purely for business purposes that your employer. Okay, that would be 3 cards then.
But you don't need 29.
You don't need 29. I cannot see this, and I get it. But this one has this kind of rewards, and this one got
right.
Okay, again, I get it. And if you are sophisticated enough to be juggling 27 different rewards programs, I guess that makes sense.
Right.
But to me, you're just opening yourself up for problems.
Right. The more access you have to credit, the more risk when something goes wrong that you're going to incur debt. If you don't have access to credit in the first place, you can't get into debt.
Yeah, it's pretty much as simple as that. So what do I need? Okay, I need a card to be able to book a plane ticket or pay for my Netflix subscription or whatever. But my priority is get it paid off as quickly as possible because that factors into utilization and history and everything else.
Right.
So again, I'm a big believer in pay it as often as you get paid.
Yep. And
that way you can never get into trouble. So yes, credit cards are a very good way to improve your credit score because they are a revolving credit. They're
if used properly.
But you got to use them properly.
Right.
If you don't, you're just going to get crushed. So that's the answer to the question. Use them properly. What did I say in our documentary, Dead Aside? Credit is like fire. It's a tool.
Mm-hmm.
I can't remember if you had a different analogy for it than that or not, but it's great if you use it correctly and you get burned and then you're toast. So there you go. Do what's right for you. So it's time for the commercial.
We haven't plugged the documentary in quite some time.
So Debt Asized, it's right here on the Debt Free in 30 channel, and it's gotten great reviews. And I think in that documentary, we do talk about exactly what we've just talked about and much more on the history. It's not just us talking about it. We have experts on it.
It's an hour well spent.
So
it's not a commercial.
If you haven't watched it, Debt Asized, just search it. It's right here on the Debt Free in 30 YouTube channel. The other channel we have, which I know you're a huge fan of, TikTok.
I thought TikTok was being banned. Am I just out of the circuit?
It hasn't been banned yet. It'll be banned now that we're on it.
Okay.
So as you know, what you and I have been doing is we've been recording very short, basically Q&As.
Right.
Here's a question. You and I sit there, we answer it. Boom. No cue cards on that one.
Right.
So if you go search for Hoyes Michalos on TikTok, you can follow us along with all of the kids.
Some of it's entertaining.
Yeah. Most of it gets cut before it gets on the show. So there you go. That's our commercials. Now, for anybody who's watching on YouTube, which is not everybody, most people listen to the audio version, but please like, subscribe. We have more than one video a week because we're putting out some of these shorts. We're trying to get as much information out to people as possible, but in easily digestible bits.
Right.
So we've got short explainer videos over on the Hoyes Michalos channel. We've got longer detailed videos answering questions about specific topics. So subscribe there. You'll get the notification if you click the bell, and you'll find out every week. Otherwise, you're a big Spotify listener. That's where you listen to everything. Or
Spotify, what's that?
Never heard of it. Okay. Apple Podcasts, the whole bit. So most people listen to the audio version. So again, like and subscribe, because next week there will be a new podcast. Until next week, thanks for listening. I'm Doug Hoyes. That's Ted Michalos, and that was Debt Free in 30.